Thank you for joining us for this webinar. I'm Nicole Aubrey, the Head of Distribution at Associate Global Partners. Today, we have the pleasure of speaking with Ryan Quinn, Client Portfolio Manager at WCM Investment Management, to discuss the WCM Quality Global Growth Equity Strategy. This webinar is for educational purpose and of general nature only. It does not constitute personal advice and it must not be acted on or relied upon. This presentation is not an offer, recommendation, or solicitation. Ryan, lovely to see you, and thanks so much for your time today.
Oh, it's my pleasure. Happy to be here.
So let's get straight into it. We're obviously living through a highly uncertain environment right now, with headlines dominated by trade tensions, inflation, and geopolitical issues. How does WCM stay focused in the long term when there's so much short term noise swirling about?
It's a great question, and I know it's on the top of mind of many investors because you can't escape these headlines. The reality is WCM has always taken a very long-term view investing in companies. We take a fundamental research approach that is really looking to be correct, not in the next quarter or two, but really in year two, three, four, five, so we can have a durable runway of opportunity for all of our holdings. Um, One consistent and constant in the market is that there is volatility, and frequently, the things you prepare for aren't the things that move your portfolio the most. So we tend to try to avoid making predictions. We're not good at them. We learned that early. So we try to avoid making predictions, but rather take what the market gives us. In volatile periods and volatility to most investors typically means drawdowns, when the market's falling. Um, that's when our preparation really pays off. Really making sure we understand the opportunity set in front of businesses, um, respect how the environment is changing. Obviously, in an environment where interest rates are being cut or down to zero, that's one thing. If they're consistently rising and high for longer, that's another thing. So we don't try to force our portfolio to work on the market. We force ourselves to work with the market gives us, and really try to upgrade when we get these. We call them buying opportunities, but others view them as short-term periods of volatility.
So, one of the things that makes WCM unique is the focus on corporate culture. For those in the audience that are less familiar, can you explain what you mean when you say you look for an aligned corporate culture? And why does WCM see this as critical to sustaining a competitive advantage?
Sure. So when we first integrated corporate culture research into our fundamental work, um, we learned very quickly that you had to have a framework because you can't just view a business and say, "Oh, that's a cool business. I'd like to work there. The culture must be good." Because we really want to see if we can find correlation between a company's culture and business outcomes. So alignment is the first piece of our framework, making sure that the company's culture is aligned with its competitive advantage. Because at the end of the day, the company's culture will define employee behavior, and in any environment, up or down or sideways, employee behavior will define business outcomes. So, really finding that alignment with the competitive advantage is going to be essential for the long term ability of a business to grow its competitive advantage, regardless of what's happening in the world around it.
And so when we talk about WCM's approach, one of the things that's described is identifying businesses where the moat is expanding. What sort of changes inside a business give the WCM team confidence that the moat is actually growing rather than shrinking? What are we looking for there?
You know, it can be a variety of things depending on the type of business. Sometimes it's a business that has evolved internally that is now expanding to a broader subset. So think of a CRM system or client management system that only focused on small to medium businesses. But then if that company, I'm speaking of a company like Monday.com, all of a sudden brings forward other functionalities that make it now a platform of offerings to their customer, that may now inflect their profitability. It may allow them to move up into, medium and larger size businesses, for very long-term contracts. And so there are businesses that innovate internally like that, that have, moats expanding from that perspective. In other cases, in difficult environments, take a Louis Vuitton. When economic environments get weaker, typically Louis Vuitton gets stronger, right? Because their brand is so aspirational, because what they do is so unique compared to other brands in the marketplace. So while weaker hands might fold in a tougher market, Louis Vuitton can maintain pricing power and actually take over marketplaces and market share where maybe smaller, more upstart luxury brands were trying to infiltrate. So really the answer is that the moat trajectory can change and get stronger in a variety of different ways, and it has to reveal itself through our fundamental work.
How hard is it to find companies that are genuinely still expanding in today's more mature markets?
We live in a world where information is extremely available. So finding a differentiated view or a variant perception, which is very important in terms of um, making investments in stocks that are going to go up, um, is harder and harder. And one of the advantages we have at WCM is our portfolios are concentrated. So we hold ourselves accountable for owning the 35 to 40 best ideas we can find in the world, which means we can do research on hundreds of other companies and keep them on the sideline and wait for those businesses to be in an environment where the opportunity set or their competitive advantage is growing. Semiconductors are a great example. We were in a semiconductor glut, a low end of the cycle in kind of 2018, 2019. That turned around 2020 and has accelerated through artificial intelligence. So in some cases, the semiconductor industry is something we've had exposure to for a very long time. Cyclically, sometimes it's strong, cyclically, sometimes it's weak. But in that upturn, if that business is really focused on the opportunity set, their competitive advantage can grow because now they have the market as a tailwind as well.
Perfect. That makes a lot of sense. And so, if we step back from the process for a second, when you and the team look at the portfolio today, are there any particular sectors or regions where you're seeing stronger signs of opportunity emerging?
Yeah, and this should kind of dovetail with my comments about taking what the market gives us. For leading up to the end of last year, really Europe was unloved compared to domestic U.S. companies in the stock market. There was a uh, period of time there where European equities were trading at a 37% discount to domestic United States businesses. And that's about two standard deviations away from the long-term average, was about a 17% discount. What we've seen since sort of the last quarter of last year and into this year, are there some structural changes happening in Europe that's actually making that region very attractive from a valuation perspective and for a runway opportunity. We've identified a few business areas like uh, aerospace, jet engines, defense contractors, and infrastructure plays like electrification and gas turbines. These are all areas of the market that have very high quality businesses in Europe that play in each of those spaces. Now, what's changed that has led us to really feel like those are some of our best ideas versus maybe some domestic companies is the fact that the European Union has announced that they are going to be spending upwards of 800 billion euros more on defense spending across that region over the next, call it 5 to 7 years. Separately, Germany announces a 500 billion euro infrastructure commitment. So, meaning, building roads and repairing some of the damage that's gone on in some of the war torn areas. So, these are things that are new to the markets right now, and that we think are going to be tailwinds for the coming, multiple years ahead.
Excellent. And is there any particular, so we've talked a bit more about regions, are there sectors where you're seeing more attractive valuations or that you think will drive more growth in the portfolio?
Sure. I mean, if this was happening if this conversation was happening in 2021, most of what I would be talking about would be e-commerce and semiconductors. Today, it's much more niche industrial plays. As I mentioned, businesses that are related to aerospace and defense have become very interesting. Technology continues to be exciting. All things AI, are driving a lot of the tech sector. But when we look at it, there's other areas of the markets that also touch that AI theme. Electricity is going to be a huge, the demand for electricity is going to be huge, based on not only the fact that electrical grids across the world need to be upgraded, but also as these server farms grow and artificial intelligence is integrated into more businesses, that will create a huge demand boost on the electrical grid. So we're really seeing a wide number of companies across a number of different industries, different than we really would have a couple of years ago, be present today.
And I've noticed there's been a couple of new stocks that have snuck into the portfolio. There's probably one that many people in the audience would have heard of and potentially bought some of their products over their lifetime. And I'd really like to bring that to life a little bit for everyone today. So the stock I'm talking about is Nintendo. What exactly was it that stood out about Nintendo's corporate culture that made it a great fit to the portfolio? But beyond like strong IP and loyal fans, what
Sure.
brought it to your attention?
We looked at Nintendo for a very long time. In my house, we bought that Nintendo Switch when it first came out. It quickly dominated my children's time. We nicknamed it the No Friendo, and limited some time that we could play on there. But the business has really evolved over time, and it's gone from being kind of a really dominated by the gaming console, which every time they upgraded the console, you had to kind of throw away all the games and start the new console, get the new controllers, all those things, to one where now we're able to leverage the prior consoles. We are in a new product cycle with the Switch 2 coming out, and that would be good just in general. But when you look at the IP, and as you mentioned, the customer loyalty, Nintendo has a lot of ways to really leverage growth going forward. And it comes at a time. So as I mentioned, we've been looking at it for quite some time, well over a decade. But what's different now is the state of the gaming market that kind of that doesn't rely on physical games to be played. You can just download the game. The fact that you can monetize in-game purchases is something that will drive financial security and growth. But really, internally, when we look at the corporate culture of Nintendo, there have been a few changes internally that have gotten us very excited. Really, they could be described as increased cultural alignment. There's been a shift to growing the ecosystem within Nintendo and the IP versus expanding the gaming population. So rather than trying to get double or triple the number of people playing on those games, you just monetize them more by offering them more in-game purchases and offering them more opportunities to download things on your hardware. Secondly, there's been an internal restructuring to combine the console and the handheld departments. This aids the chance that there will be continuous game development. There will be durability in the model, and this will also lead to successful launch of the Switch 2. I mean, as you can imagine, it's a Japanese business. They don't Japanese companies tend to avoid influence from outside, but by allowing third-party games onto this console, by combining those two departments, now opens them up a bit more than they have been in the past. And we think that cultural change, and that tighter alignment between culture and strategy really boost our confidence in Nintendo growing its competitive position.
Fantastic. Such an interesting business. And so, do you want to take us through a few of the other additions to the portfolio recently?
Yeah, sure. I mean, gosh, we've been really probably doing more work in repositioning the portfolio, in terms of making sure our highest conviction names are at the top of the portfolio. We have added a little bit of China back into the portfolio. A company called Meituan is a food delivery business and a couponing business, very domestically oriented. So outside of the noise of geopolitical pressures coming from any of the other governments outside of China, as well as Tencent, which is actually a re-addition into the portfolio. Tencent had been out of the portfolio since I think 2021, and we got back into it, having done a lot of on the ground research in China, try to understand the economic environment there, try to understand the consumer a bit better, try to understand what the government's doing to return the economy back to strong GDP growth. And what we learned was that Tencent is as valuable as ever, with their WeChat platform touching over 1.5 billion Chinese every single day in multiple different ways. But really, what's astonished us is the acceptance and integration of artificial intelligence within China across, frankly, a number of businesses. But we think it'll be really impactful in Tencent, and the Chinese consumer at the same time is voracious about their appetite for artificial intelligence. In fact, when our team came back from China, they were just blown away by how much AI had been integrated into daily life in China compared to, here in the United States where we have Apple Computer, which is, arguably one of the best tech companies in the world, and yet none of our iPhones do anything that integrates AI yet. So we'll see, but we just feel like China is leaping ahead in that AI area compared to what we're seeing here domestically. Um, yeah, so I think that's kind of the areas outside of beating kind of aerospace and defense, to death. There's just great runway of opportunity there. So we've just been sort of adding and trimming to different names to make sure that we're best prepared to capture the forward environment, right? We had a tremendous run last year. We're feeling really good about where we sit year to date from a performance perspective, and really making sure that we maintain the portfolio in a way that gives our investors and our partners the best opportunity to profit. Is where the focus is.
Now, we've got a quick question from our audience as well. So, there's a lot of global managers that have a big allocation to the Mag 7. And, that's driven a lot of performance in global markets over the last 12 months. That's not how WCM operate. How has WCM been able to deliver the performance with its portfolio with such limited exposure to these stocks? And maybe you could explain which ones you do own and which ones you don't for those in the audience.
Sure. So we always believe in having a balanced portfolio at WCM. We're not the type of manager that makes a big market call that repositions everything and kind of puts all the eggs in one basket. There are managers out there that have done that well. In my experience, that works well until it doesn't, and then you kind of destroy everything that you built prior. So we want to make sure we have a broad set of exposures to different business cycles. And by having 35 to 40 stocks, we can have a balance in the names that we own, meaning that every single company we own can move the needle and make performance. And our favorite type of performance, well, last year was a great year. We had one standout performer in AppLovin last year, but really, if you take AppLovin out of last year's performance, the rest of the portfolio still beat our benchmark. And that's something that we really look for, right? We're not trying to be a one-trick pony. Um, we added what I guess members of the Mag 7 beginning in 2022. We had looked at our technology sector and we had been over indexed towards e-commerce and semiconductors. We didn't have exposure to cloud computing. We didn't have exposure to enterprise software. And so over the course of 2022, we added Microsoft and Amazon in for their cloud computing exposure. And then in early 2023, we added NVIDIA into the portfolio. NVIDIA, arguably and admittedly was up 100% when we bought it. Now it's been a wonderful holding since then. But the reason we were able to own it was, the shift that this company had gone through. Their ability to provide all things AI in an environment where really they were the sole winner out there. It was going to be winner take most for quite some time. And so we did add NVIDIA to the portfolio there. But again, at a 3% position, which is kind of like a core starting point for many of our holdings. We've obviously looked at Meta and Alphabet and Tesla and all these other businesses, Apple, and we just haven't gotten there with them. They don't meet the quality growth metrics that we care about, that are supported by aligned, strong and adaptable cultures.
Excellent. Thank you. One of the key things that WCM do that I think is quite different is your your slogan for the business, or the philosophy of the business is really to think different. I'd love you to take the audience through for a couple of minutes. How does that work in your business? How does that work in the investment team? What does that mean? What are you doing that's different?
Yeah, it can expose itself in a number of different ways. Thinking different sometimes means the research team picks the most hated economy of the world and goes and visits that economy, right? And if the whole market hates something and they're punishing those stock prices, it's probably worth going to that market to find businesses that are actually getting better in that environment. That maybe the way is being opened up for them to actually have future success. The way we think about our portfolio, we've never owned all the Mag 7. And we don't care. It's purely, does a business meet our character, our quality, our moat trajectory, and culture needs. We're willing to look a little bit further outside the box. We own a company called Waste Connections, which is a Canadian garbage company. We're we're supposed to be this global growth equity manager, and one of our industrials businesses is a trash company. We're willing to sell businesses based on cultural changes. We had owned First Republic in 2022 and sold it because the culture had degraded away from being one that was out in front of its clients, anticipating what they need, to one that was saying our clients tell us what they'll need. And so we exited on that cultural reason. And fast forward 6 or 7 months, there was a run of deposits on that bank. Stock fell significantly, and JP Morgan ended up buying them for a song. So thinking differently allows us to sell over-earning business cycles like luxury. We exited Louis Vuitton last year, and we identified aerospace and defense early last year as business cycles that had under-earned their pre-COVID growth rate. So by looking for those types of things, we're able to sell things that have won and paid us a lot of money, and go in and do the work on the businesses that have been unloved or underloved by the market. And if we find the characteristics that we like, we're willing to include them in the portfolio, regardless of what anyone else is doing. And frankly, being in Laguna Beach, California, not downtown New York City or in Chicago or San Francisco, um, allows us to think differently, because we're not influenced by other analysts, other portfolio managers, or any other institutions, because we bump into tourists, artists, and locals.
And do you think that translates too into the way that the investment team operates and collaborates with each other when they're doing stock research and when there's stock ideas coming up into portfolios?
Yeah, I think our team's setup is one that is really helpful for the way we invest, and has translated into very strong performance. Our team is motivated as there we have portfolio managers, and we have generalist analysts, and then we have our culture analysts. Everyone works in a very flat environment. Everyone has the opportunity to pound the table and have high conviction on an idea. Everyone has an opportunity and is incentivized to highlight something that maybe has changed. Maybe we need to trim back from it, or outright sell it. So the ability for our team to operate without fear of career risk is something that is very powerful. You can't overstate how intimidating many of these other money management firms are internally. If there's a tech sector head that's hell bent on loading the boat with whatever stock it is, and I'm a junior tech analyst and I completely disagree, I have career risk if I go against the tech sector head. It doesn't exist here at WCM. As I mentioned, you're almost more celebrated when you help get out of a situation early, or identify something that makes a portfolio management decision easier more quickly, than you are finding the highest performing or highest grossing stock in any given year.
Excellent. Thank you. And then I have one final question for you, unless we have any further questions from the audience, which is WCM around outlook. So WCM's delivered really strong performance even through challenging markets. As you look ahead, what gives you confidence that the process will continue to deliver despite the certainty and noise in the background?
Yeah, I think it's that commitment to iterating, the commitment to everyone understands that you take cookies when cookies are passed, meaning like if the market is good for us and we have the wind at our back, let's ride that wind. But when we do get these periods of volatility, especially when investors are asking very specific questions like, what are you doing in response to this tariff? What are you doing in response to that litigation? Those types of things we certainly pay attention to, but it just helps us with a mosaic of what the environment looks like going forward, and it helps reframe our thinking as to, okay, maybe the tech sector or healthcare sector should be de-emphasized a little bit, and let's get some more cyclical growth businesses at the front end of the portfolio. Let's make sure we have businesses that are really adaptable, so that in the event that there are tariffs between Canada and Mexico and us, how are these businesses going to adapt to try to minimize that impact? So really, the commitment to investing through any environment, no matter what it is really something that I think helps us move forward. And when you look backwards and say, okay, 2022 was a horrific year. It was really challenging for our style, really challenging for growth investors. But we didn't just throw our hands up and say this isn't fair. We did our best to upgrade the portfolio. And what you're seeing, and I was saying this when I was coming through the country in 2023 and 2024, that all of the work that and all of the learnings that come from a year like 2022 really provide significant duration of returns in the portfolio, because we recognize the shifts, we learn from our mistakes, we highlight things that work, we identify and try to eliminate things that held us back, and so constantly trying to iterate and get better and upgrade the portfolio for what the market gives us, and don't try to put a square peg in a round hole.
Excellent. Thank you. We've had a couple of late questions that have come through the chat box. So we'll see. We've only got a few minutes left, but we'll see what we can do. We've had some stocks that have been particularly volatile in the portfolio over recent times, like United Health, AppLove, and Arista. Do you want to give us a bit of an update on how the team are thinking about those positions at the moment?
Sure. So very different companies, right? Arista is the networking business that basically is a way to play the increased need for networking coming from demand from AI. That has been really a lot of what we're talking about with these three names is first quarter volatility, because what happened in the first quarter, the Japanese large language model came out and was at a significant using quote unquote dumber chips and less energy than ChatGPT. So that hurt the networking demand, right? That stock was negatively impacted by that DeepSeek announcement in January. When we talk about AppLovin, tremendous performer in 2024. Not unusually, when a stock runs as much as AppLovin did and garners as much attention as it did because of its success, frequently the short sellers will come out of the woodwork. And in this case, there were two reports that were really put out in mid-quarter that challenged AppLovin, saying that they were faking revenues and all sorts of outlandish commentary. But what you have to look at is, first, number one, the merits of it, right? We read these reports and we do our own homework. But when did the report come out? Right when the executives had to go into a quiet period. The SEC mandates that executives can no longer release information financially about the company post this kind of talking period, and they're going to a quiet period. So they had no ability to refute the claims by the short reports, and so that stock fell on the back of that. Timing was suspicious, and frankly, we thought the report was unwarranted and it had carried no water. There was a second report that came out. This one was a bit nefarious because the group had announced a short position in the stock and then released their report, which is effectively a rehash of the first report. The stock fell a bit more, and they covered their position. So that was a bit of a smash and grab. Honestly, internally, we were thinking about buying more of AppLovin, even though it's at such a large position in the portfolio. We did not, but we just felt like that was short-term noise that was going to be, something you have to live with. And we still believe that the long-term opportunity for this ad network and mediation platform to really revolutionize advertising across these different networks through their Axon 2.0 AI engine. So we remain extremely confident there. United Healthcare is a bit different story. Healthcare is consistently at risk of political change. Every 4 years, we get a new president here in the United States, and frequently healthcare reform is a platform that people run on. United Healthcare's strength is really their network. They are vertically integrated in their industry. In some cases, it can be challenging to discern the financials, and there have been some negative headlines around the company. We have had that business in the portfolio for a little while. However, it's at a lower end of the portfolio, so we are digesting. We tend not to make knee-jerk reactions. It's at a position in the portfolio where if it goes down, yes, it hurts, but it won't take away from the rest of the portfolio. So we're currently in kind of a re-underwriting of that one, trying to really understand the operating environment. What does it mean for the company as the managed care or the Medicare Advantage changes come to be? What does it mean when we see actual drug pricing change, if it will or not? It's really reacting on a lot of things that are yet to really be in stone. So we maintain it at a small position in the portfolio. If we gain confidence that the market is wrong, we will gross that position up to try to make as much of the positive on the way out of this. Or we may find a better idea that we like more, and it could be a source of funds. But we're kind of in that limbo at the moment, doing our work. Hope that
Excellent.
answers those three questions.
No, that was fantastic, Ryan. Thank you so much. Really appreciate it. Appreciate it. I'm conscious of time. There's still a few questions in the chat box that have come through, but what I will do is I will make sure that someone in our teams come back to all of those questions today, because I am conscious that we want to make sure that everyone can get back to their days. So thank you so much for your time, Ryan, and for everyone who joined us today. I thought that was a very enlightening session, and certainly very thought provoking. If you've got any other questions about the strategy or any questions that have come out of today, please contact us by calling 1300 052 054 or emailing us at invest@associateglobal.com. Thank you again, and we look forward to seeing you all soon.